Let's bring in Chris Murphy, co-head of derivative strategy at Susquehanna, and our own Mike Santoli. No pressure, Chris. But first of all, can you just comment on how unusual this is?
Hey, Kelly. Yeah, had a huge increase in this 0-day to expiration type trading, and just that within a week, a couple-day expiration. One thing to keep in mind is it's pretty much all opened and closed, or bought or sold, or the reverse over the course of the day. So there really is no time to build up these massive offside positions. So when I hear about comparisons to Volpacalypse, remember that took an entire year, which was 2017, of just relentless selling of volatility until these positions got so big, both institutional and retail, that it finally unwound. Option trades that occur over the course of one day and then expire, that they're basically wiped clean the next day. So, I'm not seeing, what some of those comments you just mentioned.
Yeah. Would you say, Chris, that you see other signs in options markets or just in general in terms of positioning that point to either, worrisome complacency or extended risk taking or anything like that?
Well, look, volatility levels are down from where they were last year. They're down from where they were during COVID, but they're still elevated compared to long-term history. So I wouldn't necessarily call it complacent. We've seen an increase in skew, which everybody likes to look at as well. But that might just because people are building up their positions and need to hedge a little bit more. And those tail options don't come in nearly as quick when the rest of the volatility comes in. So I'm not seeing quite as many of these risky signs as maybe some others are.
Sure. Mike, what do you think explains the sudden popularity of these types of options?
Any tool that is introduced that creates a more targeted ability to, bet on the next move, the next short, period of time ahead of us is going to get outsized adoption. It's just the way it is. They introduced leaps, these long-term options. Yeah, sure, they were useful on paper, but they don't create that sort of two-sided activity in the moment. So I think that the market trading community is always going to kind of rush to adopt these things. There's another sense out there that they've been integrated in a lot of kind of quantitative trading models. There's really arbitrage going on below them, a lot of writing of options on an intraday basis, trying to capture interest rate moves. It's pretty complex, but I won't deny retail investors have definitely flocked to them too. It's become popular. It's become a popular talking point. I'm not opposed to the idea that it perhaps alters the intraday rhythms a little bit. You have dealers that have to hedge exposures if you do get a sharp market move. But I just don't really believe this is the cause of directional market moves. Principally, as Chris was saying, you don't really have time for people to be loaded on one side of the boat. But choppy within a range and ping-ponging between various index levels, that I can see being the case. And then if it gets too stressed in a given day, because of fundamental news, maybe it helps as an accelerant to create some kind of short-term cascade. But I don't know exactly how it could build up in a big way.